Hello, this is Jim Ammerman, Managing Director at Fortress Wealth Management, and this lesson covers Roth conversion scenarios for those in the middle income tax brackets. We're looking at 80,000 to 330,000 taxable income, which is a huge portion of the working couples out there. I'm hearing concern from these clients about taxes, and they're worried about the future taxes they will owe or their kids will owe on their pre-tax retirement accounts, such as traditional IRAs, traditional 401ks, SEP IRAs, simple IRA, 457, 403b, cash balance pension, etc. And unfortunately, this is a valid concern with $28 trillion in debt and counting, and rates scheduled to go up anyway in 2026. Fortunately, there is an effective way to address this concern, and it's called a Roth conversion. It's a long-term decision with potentially large payoffs. And we're going to make a case that many investors, even those who think they will be in lower tax brackets in retirement, might be well served to prepay taxes through the Roth conversion mechanism. Roth's going to show you how to treat that decision like an investment and determine the cash-on-cash payoff for these conversions. Like any investment decision, that answer is dependent on some assumptions and projections. So to start, we're going to challenge the standard assumption that most people should not convert because they think they'll be in a lower bracket in retirement. That assumption is not a given, and there are at least three reasons why we believe that assumption can often be false. Number one, as I mentioned, the US is running massive federal deficits. Social Security and Medicare are financially stressed. So a more aggressive means testing could be on the horizon for them. Many couples in the 24% federal bracket, which goes from 173,000 to 330,000, are scheduled to see a 9% increase on their marginal tax rate starting in 2026. And some couples who are in the lower 22% bracket might see a 6% rate bump in 2026. Number two, for investors with large pre-tax balances, the IRS required minimum distributions alone might not be enough to cover their expenses, and additional withdrawals will push them into higher tax brackets. That's even more of a problem when one spouse passes away, and they are then subject to the single filer tax brackets. Your taxable income does not tell the whole story as to your true marginal tax rates. Other factors, such as the Medicare premium tiers, the way Social Security is taxed, capital gains tax rules, Medicare surtax, net investment income tax, qualified business income deductions, these all can increase your true tax rate, and many of these apply during retirement years. But let's go ahead and look at a scenario where taxes do go down in the future. So we've got Ben over here on the left side. It's 2021. We're going to look at a projection going out 25 years to 2046. In green here, we've got his current tax rates, 24% federal plus California state, 9.3. He's looking at 33.3 total. Long-term capital gains rates, 24.3 total, including California. And in the future, we're assuming his rates go down 5%. Might be unlikely, but let's go ahead and make that assumption. So he's at 28 and 19 on his tax rates. Now in the blue section, let's assume he's got at least 300,000 in pre-tax retirement accounts. And 300,000 was determined to be the optimal amount to convert after a careful analysis utilizing e-money software to find the ideal amount to convert. And let's say he's got almost 100,000 in cash that he's going to invest on the side there. After 25 years, assuming 7% growth per year, this would be his total on those two investments. And the required distributions would trigger taxes totaling this much. Now that would be over multiple years, but we're going to consolidate that to make things simple here. Capital gains tax would be about 85,000. After those taxes, he's left with a net total of 1.62 million. if he did a conversion of that 300,000 over here in the peach section, the cash is used up to pay the tax on that conversion. This 300,000 grows at the same rate because it's the same investments. A conversion is really just relabeling a portion of your retirement account as Roth, and now it grows tax-free. So that tax-free growth means no taxes here. And he ends up with about 4,000 more 25 years from now. So not a big bang for his buck on this strategy. There's only a 0.2% increase. And it was probably not worth the effort, but we were assuming a 5% drop in rates. Like I said, rates may not end up actually being lower for you in retirement. And a careful analysis utilizing, like I said, some quality financial planning software like eMoney will allow us to find out what your true marginal rates are in retirement. If we found out that rates were only going to drop 2% for you, then the return on investment becomes a little more interesting. It's a 66% bump in net worth. If there's no change in the rates and you have the same rates in retirement, now we have 107,000 increase in your net worth. And if rates go up 9% and 5%, as I mentioned, that's scheduled to happen in 2026 for a lot of people in the 24% bracket. And capital gains rates increases have been thrown around this year, with 5% being one of the bumps discussed. Now we're looking at over $250,000 of net worth increase. And this is just over 25 years. Let's take a quick look at what happens if you're looking at a 40-year time frame. So maybe somebody younger is considering a Roth conversion. Now we're going out to 2061. And now with these increase in rates, we're looking at 800,000 plus of net worth increase. Present value of that is 368,000. So a strategy like this can create a huge amount of value, but you want to be careful and make sure that your analysis is very detailed and accurate. If you have any questions about this, or if you want a free assessment on your specific situation, I'll put up my information. You can send me an email to jim@fortress-wealth.com. And thank you for your time.